Good afternoon, everyone, and welcome to Deloitte's Debriefs tax webcast series in Asia Pacific. Our webcast today is from our new tax controversy series. The environment for tax controversy in the Asia Pacific region has picked up and accelerated rapidly in the last 6 years since the OECD's G20 Finance Committee met in Brisbane, Australia. And whilst we've seen tax office activity abate during COVID and governments providing a lot of incentives to businesses, that focus has now shifted back to tax collection. And therefore, we believe that a series focusing on tax controversy is both timely and extremely relevant in Asia Pacific. Given this environment, we've prepared a special 3-part mini-series to introduce our controversy debrief series. The first of which is today's session focused on general anti-avoidance. Our second session will focus on transfer pricing, and our third session will go into the administration by tax authorities and controversy practices in the region. My name is Neil Pereira, and I'm a tax and legal partner based in Deloitte, Sydney, Australia. Together with my colleague Colin Little, who is a legal partner in Deloitte, Sydney, we have the pleasure of hosting today's webcast and the ongoing series. We have 4 speakers with us today, all of whom are controversy experts in their regions. Campbell Rose, who will cover New Zealand, Jun Takahara, who will cover Japan, Sharath Rao, who will cover India, and Shanice Su, who will cover China. You may access each of our bios on the left hand of the screen. But before I go into the agenda for today's webcast, I'd like to highlight some of the features of our webcast console. First, all users are in listen-only mode. If you have any content-related questions, you can submit them at any time in the Q&A box at the bottom right of the screen. We'll monitor this and do our best to respond to your questions during or after the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the polling questions on their screen. Thirdly, if you require an attendance record for this event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console.
Thanks, Neil. And now for our topic today. As Neil mentioned, the environment for tax controversy in the Southeast Asia region has picked up and accelerated rapidly. And whilst there was a pause for COVID, this activity has now shown green shoots and is starting to resurge stronger than ever. Actionable moves have been made in the area of BEPS and the automatic exchange of information, with the majority of countries endorsing the OECD's recommendations. Some jurisdictions have taken unilateral action, for example, in implementing a digital services tax. This highlights the difficulty in achieving consensus and the potential distortion and mismatch that arises from different approaches taken by different tax regimes. We've seen countries like the UK take the lead with various BEPS initiatives, including, for example, the diverted profits tax. And in our own Asia Pacific region, many countries are close behind adopting BEPS rules and introducing new, strengthened transfer pricing rules. In today's session, we wanted to focus and explore on how the general anti-avoidance rules operate in a selection of countries. And each of our speakers will take us through their country's recent cases and their own experiences in dealing with the laws in their jurisdictions. After that, we'll have the opportunity to join our speakers in a panel session to provide their observations on how some of these specific issues in each country may be seen by tax authorities in other jurisdictions. We will respond to any Q&A after the presentation.
Thanks, Colin. What we wanted to do as a first up is to run through a polling question with all our guests. And the question we have today is, what has been your recent experience with the tax office in relation to reviews or audits in Asia Pacific? We're after some recent experiences and some feedback, which will inform the rest of our presentation. The responses are cooperative, voluntary, formal and involving the use of statutory powers, adversarial and involving search and seize powers, or a combination of the above. And while we wait for the results to come in, Colin, I've just got a question for you. From a personal perspective, what have you been seeing in Australia recently?
Sure, Neil. I guess in general for audits in Australia, and particularly having come through the COVID period, we've seen the ATO take a cooperative and voluntary approach to audits in general. However, where there is the application or the potential application of the general anti-avoidance rule, our tax authority here will always invoke the use of statutory powers to issue a formal notice to make sure that they've basically scoured all the documentation available to try and determine the purpose of the transaction, whether it be a tax purpose or a commercial purpose.
Thanks, Colin. And now we can see the results of the survey have come in. And to a large extent, there's been a mix of, I suppose, experiences. It's probably pleasing to note that there's very few participants on today's call that have had an adversarial and formal search and seize type of experience with the tax office. A lot of it does seem to be mixed, though. Well, that's good to know, and that I think will inform our discussion today. I'd like to now pass over to Campbell to take us through the New Zealand presentation.
Thank you, Neil. So look, in New Zealand, we've had a general anti-avoidance provision in our legislation since 1878, or we've got a sneak preview of what I'm talking about. Look, our provision was amended in around 1974. We had some criticisms from the Privy Council, and it's now found in Section BG1 of our Income Tax Act 2007. So starting off with how our New Zealand courts approach tax avoidance questions. In New Zealand, our highest court is the Supreme Court, and that court's first judgment on our Section BG1 was called Ben Nevis in 2008. And before that, as I mentioned before, we were governed by the Privy Council. So I'll come back to Ben Nevis in a moment. The most recent statement by our courts on general anti-avoidance is our Court of Appeals judgment in Frucor and the Commissioner from September 2020. So the context there was a cross-border financing arrangement to fund Danone acquiring the Frucor Suntory Group. So you can see on the slide there plenty of boxes and arrows. I wanted to briefly step you through what was involved. So Deutsche Bank, you can see there advanced 204 million Kiwi to Frucor. That's the green arrow down the very bottom there. Deutsche did this by subscribing for optional convertible notes issued by Frucor, interest payable at 6.5% per annum with maturity in 5 years. So you can see there the 66 million blue line there of interest being paid over the 5-year term. Frucor used that 204 million to repay acquisition funding that a Danone Group Treasury Company had originally provided. You can see on the left-hand side there, the $144 million being repaid there. The remaining 60 million was used by Frucor to return capital through share repurchase. You can see that arrow going up to Danone Asia Pacific. So at maturity, repayment could be satisfied either by cash or by Deutsche exercising an option to acquire non-voting shares in Frucor. You can see the red line there down the bottom, shares being issued to Deutsche Bank by Frucor. Now, it was common ground as part of the case that Deutsche would elect to take the shares in all but a doomsday scenario. So how did Deutsche itself fund the 204? You can see there, the same time as it subscribed for the notes, Frucor's parent, Danone Asia Pacific, entered into a forward purchase agreement to buy those Frucor shares at the end of the term if they were issued to Deutsche. So there was a forward purchase price paid. You can see the 149 million there, paid by Danone to Deutsche Bank on day one. Danone itself was funded to do this through an advance from BNP Paribas and through that $60 million capital return I mentioned before. Remaining 55 million of the 204, you can see, was provided by Deutsche Bank's treasury function outside New Zealand. So over the term, as I mentioned, Frucor paid interest of 66 million. Deutsche, in turn, repaid principal of 55 million and interest of 11 million on the funding it had got from its treasury vehicle. At maturity, Deutsche Bank exercised that option to accept repayment through Frucor issuing shares, and you can see there the shares were then transferred out immediately to Danone in accordance with the forward purchase agreement. Now, Inland Revenue denied the $66 million interest deduction on the basis that the financing arrangement was a tax avoidance arrangement. They contended that in reality, Frucor had really only borrowed $55 million from Deutsche. That's the 204 you can see there, less the 149 forward purchase price. And so the Commissioner sought to limit the interest deduction of through course to just 11 out of the total 66. In the High Court at first instance, Justice Muir found in favour of through court. He said, look, Inland Revenue, you can't analyse the arrangement on a single entity level for some purposes. So, for example, interest withholding tax payable on that $66 million cash flow, but then for other purposes, collapse the whole thing on a group basis and ask how much had through court really borrowed. They also argued, this is in Inland Revenue, that certain features of these notes were not market or not truly arm's length. Interestingly enough, our High Court cautioned against that sort of approach, saying that it was based on a straitjacket of orthodoxy. And Justice Muir asked, are those non-market features really relevant to the core tax avoidance analysis and whether or not those interest deductions were permissible? So if we move to the next slide now, that judgment was appealed to the Court of Appeal, so our second to top court, and the Inland Revenue won. So the Inland Revenue found that the financing was a tax avoidance arrangement, and they allowed interest deductions on a net loan only of 55. So 55 of principal and 11 million of interest deductions. So I'll walk you through briefly what the court found. The court found that Frucor had used the interest deduction rules in an artificial and contrived manner that cannot have been within Parliament's contemplation. And what the court said is, looking at the commercial and economic reality of the arrangement, we just go back one slide, sorry to take you back, I just want to illustrate this with the numbers. That out of the 204, you can see there at the bottom line, lent to Frucor, that really 149 of that was in reality a subscription for equity on day one. And what the court found was this was effectively repackaging that equity subscription by Danone Asia Pacific as an artificial and contrived loan to achieve a tax advantage. What the court said is the purpose of the loan was to dress up a subscription for equity as an interest-only loan to achieve a tax advantage. So again, in the court's view, that $55 million you can see there going from Deutsche back to its treasury was really the true interest-bearing debt. Flick back to the Court of Appeal with the next slide there. The stated goal, the court said, was to provide tax-efficient funding for Frucor. Interestingly enough, and not surprisingly perhaps, the court did rely on a lot of evidence to get to that conclusion. And I think this is quite interesting. We might come back to this later. A lot of internal emails, letters, memoranda, and so on between Danone and the bank and other counterparties. And the court focused a lot on the language that was used and the articulation of New Zealand and offshore tax advantages, as well as net economic exposures for the parties as well. Quite noteworthy, the correspondence did also outline, the non-New Zealand tax advantages of funding, such as cash accumulation, retention benefits, Singapore tax benefits, lower fixed rate Kiwi dollar funding, and so on. The court also wasn't persuaded by the fact that over the term, Deutsche would have had an enforceable right to be repaid the full $204 million as a creditor ahead of shareholders as a debt funder, and also that Frucor had recognised a $204 million liability in its accounts under IFRS. Final point. Frucor argued that, look, I could have borrowed the 204 directly from Danone, and I could have claimed the same interest deductions. I equally could have entered into a different forward purchase and again could have claimed the same interest deductions. And the court said, on an avoidance analysis in New Zealand, what's actually analysed is the actual agreement entered into, not a counterfactual. Second issue, you can see they're counteracting. The question was, well, if we've got a tax avoidance arrangement, what's the tax advantage to counteract? They said, the real expense here was the $11 million, so 55 of the interest deductions out of the total 66 should be counteractive. So I mentioned before, it does seem quite punitive. That existing cash management agreement I talked about at the beginning that was already on foot, that was generating interest deductions more than the $11 million that the court actually allowed. There's another principle I've referred to there. I've called it base level allowable deductions. Some of our cases talked about counteracting an increment above a legitimate base level, not that base level itself. So again, the argument from Frucor was the base level is the interest expense on that existing group funding. But again, the court rejected any reliance on a counterfactual. So I think it'll be very interesting. This judgment has been appealed to a Supreme Court to see if the Supreme Court takes such a strict view. Final point you'll see there I've raised is shortfall penalties. Frucor won on this aspect. Court said that, whether in terms of whether an unacceptable tax position is taken, the question is whether there's a substantial merit in the arguments or whether it would be seriously considered by a court. The court said, look, the lower court, the High Court, actually came to the same conclusion as the taxpayer was arguing, so logically a position that could be seriously considered. So as I mentioned, being appealed to our Supreme Court, our top court, hearings are going to be held in June. We're all certainly waiting with anticipation to see how those 5 judges will deal with those issues I just outlined. Now I'm going to close out, if I can just move to the next slide, please, walking you briefly through how our tax office, our Inland Revenue, says it'll approach tax avoidance issues in practice. What we've put up on screen there is a flowchart that summarises the approach that they will take. It's from an interpretation statement published by our IRD, our Inland Revenue, in late December last year, revising the earlier statement. Taking you to step 4 there, that's sort of the end of our journey. It's what we call the ultimate question in New Zealand. It's taken from that Ben Nevis case I mentioned at the outset, and that ultimate question is whether the arrangement viewed in a commercially and economically realistic way makes use of the specific provision in a manner that's consistent with Parliament's purpose. Putting it another way, is the tax outcome something that cannot have been contemplated by Parliament? That's the ultimate question we ask. The other steps there are reasonably logical. You start with looking at the legal arrangement and what its tax effects under sort of black letter law before you think about avoidance. Step 2, what's Parliament's purpose? And you can look at the words of the legislation, their context, case law, extrinsic material. Third step there, look at the arrangement in a commercially and economically realistic way. And that's, in essence, an economic substance approach. Court says that's not the same as economic equivalence. You do still look at the actual arrangement entered into, and they do say that you can't look at counterfactual. So you can't look at something else the taxpayer could have done, but it would have achieved the same economic outcome. And then, as I say, you arrive at that ultimate question. One thing that our Inland Revenue does seem to be very focused on, and I will come back to this later quite possibly, is, was the tax outcome achieved through artificiality or contrivance? They do seem to have put a lot more emphasis on that in this most recent version of their statement. The previous version talked a lot about facts, features and attributes that you expect to be present, and really artificiality was mostly relevant if it directly impacted on the permissibility of the tax advantage rather than just being something that in and of itself was offensive. The final step in our analysis there is whether, if there is tax avoidance, it's merely incidental to to other purposes. And I should say that in practice, not much time is spent on this aspect, because it does, if an outcome wouldn't have been contemplated by Parliament, you've got to say, our courts would say it's not merely incidental. So we do hope that our Inland Revenue will hold off finalising this statement until they've heard that Supreme Court judgment in through court, because we do think we're going to get a lot more guidance from the court, particularly given it's relating to a cross-border financing arrangement. So, Neil, that's it from me. I'll hand back to you, and we'll hear from another country next, unless there are any questions at this point.
Thank you very much, Campbell. That was very informative. And what we're starting to get a sense of is that different jurisdictions obviously have a very different approach to the implementation of their general anti-avoidance rule. We'll now turn to June, who'll talk about his experience with Japan.
Thank you, Colin, and hello to everyone. To begin discussing Japan's anti-tax avoidance rules, let me start by saying that Japan does not have statutory GAAR. Instead, the Japanese Tax Authority is given broad discretion to combat perceived tax avoidance within the Corporate Tax Act itself. Using such discretion, the tax authority is able to make an assessment against transactions deemed abusive or intended to avoid Japanese tax. They can then apply established doctrines such as substance over form or disregarding the transaction to then reevaluate the transaction in order to make an assessment at the conclusion of the tax examination of the taxpayer. To illustrate some of the limitations, though, of this broad discretionary power, as well as highlight trends and some best practices around audits and controversy, I've selected Universal Music, which is an ongoing case for us to look at. This is an anti-tax avoidance case in which the tax authority alleged that an intercompany loan extended to the Japanese subsidiary of a global group. The plaintiff in this case had as its principal purpose the reduction of Japanese taxes. The facts of the Universal music case at a very high level were that the group executed a series of transactions as part of a reorganization of its business, including its music business in Japan. As part of the Japan reorganization, an intercompany interest-bearing loan was extended to Universal Music GK, the Japanese entity at the center of our diagram here, by the group FinCo, the purpose of the loan being to acquire the shares of Universal Music KK from Universal Music Trading Company, a related party. Universal Music Japan then reflected the interest deductions of the loan, associated with the loan, on its tax returns, which upon audit, the tax authority denied, using its anti-tax avoidance discretionary powers, alleging that the purpose of the loan was essentially, the principal purpose of the loan was essentially to reduce the tax burden of the Japanese subsidiary. Universal Music appealed the assessment to the Tokyo District Court, which held in favor of the taxpayer, citing that the loan could not be found to be economically unreasonable, just quoting here, because the group reorganization had valid non-tax business purposes, not only for the group as a whole, but for the Japanese subsidiary as well, end quote. The Tokyo High Court, upon appeal by the tax authority, upheld the lower court decision, and the case is now pending a final ruling at the Japan Supreme Court level. Now, it's interesting to note that if you go through and read the actual opinions of the case, the High Court did take a slightly more critical view of the transaction than the District Court, but both courts ended up holding in favor of the taxpayer, citing the non-tax business objectives provided by Universal Music to counter the government's claim that the transaction's principal purpose was to reduce Japanese taxes, and the taxpayer's ability to demonstrate the economic reasonableness of how the intercompany loan had actually been structured. So what this case therefore demonstrates is that, one, the government's discretionary power to make assessments against taxpayer positions using the anti-tax avoidance discretionary powers have limits. Second, it further establishes the courts as impartial arbiters of Japanese in tax controversies and the adherence to established legal principles when enforcing Japanese tax laws. In other words, although the tax authority has broad discretion to prevent tax evasion and tax avoidance under the Corporate Tax Act, this discretion has to be balanced with the principles of established tax law, which look to the history of the law and the intent and policies for which those laws were created. So accordingly, the courts held in the Universal Music case that the taxpayer's position should be respected, as the company was able to demonstrate that the principal purpose for obtaining the loan was not to create an interest expense to reduce Japanese taxes, but rather to acquire a complementary business as part of a reorganization to achieve the group's valid business objectives. And this highlights the importance that taxpayers be able to demonstrate the bona fide non-tax business purposes for how they conduct their business and support specific transactions. In the case of Universal Music, for example, the taxpayer cited amongst the many non-tax business reasons for the reorganization, entity rationalization, better alignment with group synergies, developments in the industry and the competitive landscape, adhering to transfer pricing principles, and structuring the loan that was consistent with the company's, like the global group's global treasury and finance positions. And I just sort of point out that, like, although this is a pending case at the Supreme Court level, and I don't want to jinx anything here, it is consistent with other recent court cases that indicate, one, that the courts are taking a more active role with respect to complex international corporate transactions, and two, that the courts are not simply rubber stamping the allegations of the tax authority. And so, for example, there's a recent Supreme Court case in which they confirmed last year that the administrative circulars, which are issued by the Japanese tax authority, do not carry the same weight as underlying statutes and regulations, but rather only reflect the tax authority's interpretations of those statutes and regulations. It's surprising to me that they actually just confirmed that last year, but again, that's the state of play in Japan. So what are the practical takeaways and lessons here? So since a tax controversy begins with a tax examination in Japan, methods to mitigate tax controversy in Japan include considering, for example, getting a ruling from the tax office on the expected tax treatment of a transaction and or the use of APAs. In the case an audit actually does arise, then the recommendation has to be to prepare and have relevant documentation at hand, and to actively manage the audit process. For most companies, audits generally occur on roughly a 3 to 4 year cycle, something you can plan for. If it's a larger company, the audit cycle might be 1 or 2, more frequent. And that reminds me, just as a quick update on the COVID-19 state of play, it should come as no surprise that there is an expectation that the number of tax audits and tax controversy cases in Japan, these are all basically put on hold or delayed since the start of the pandemic last year. Basically, audits and tax controversy cases are expected to increase. This decision last year not to commence new tax cases was really because it was more of a form of relief for taxpayers, as well as recognition by the government that it would be practically impossible to conduct in-person audits. And those audits generally take place at taxpayer premises when offices were being closed and people were mostly working from home during the pandemic. That said, as the pandemic comes under control and life returns to normal in Japan, again, it's expected that there will be more tax audits and cases coming in the coming years. That said, there doesn't seem to be any indication that the tax authorities are expected to become more aggressive in the positions that they take with respect to audits or tax controversy. So quickly back to handling of audits. So I mentioned that it's important to maintain control over the scope of the audit and also the information shared, information being evidence. And the last part of this, of course, is cooperating fully with the auditor's requests during the audit. Now, having said that, I recognize that anybody on the call that has ever experienced a Japanese tax audit, or anybody in the future who will experience a future tax audit, will be told at the beginning of the audit that they should show cooperation with the tax authorities and to willingly respond to information requests in order to quickly resolve the audit. Now, this tactic seems more grounded in hope than in responsible audit management, especially when you're considering, if you're head of a global tax group, the need to balance time and limited resources to be able to responsibly control and monitor the types of information and responses that you're providing, as well as ensure that the positions being expressed in Japan are consistent with the global groups. So the question, and it often comes up like in audits, for example, if you get a question of whether or not it's necessary to provide general group entity information unrelated to, say, for example, Japan operations to explain the Japan business. So that's a question of to review your facts. Since I believe I'm running out of time, let me offer the following clarification on this point, which I hope people find useful. The National Tax General Rule Act does allow the tax authority the right to ask taxpayers to submit relevant books, records, and other materials necessary for it to conduct tax examination. It also provides that same authority to request interviews of the taxpayer and its personnel. No stretch of the imagination that most tax authorities in the world, I think, would try and interpret that rule as broadly as possible. However, the power to request taxpayer information and to request personnel interviews is limited by the requirement of necessity. So in reviewing an information or interview request, taxpayers should consider whether the request is objectively necessary to the scope of the audit being conducted. And if the taxpayer believes the request is too broad or irrelevant, then acting in good faith and in the spirit of cooperation, the issue should be raised with either the tax examiner or the tax advisors during the audit kickoff with the tax officers in order to resolve the matter. Oftentimes, ground rules for audits are discussed with the tax auditor team during the audit kickoff, and attending this meeting to be introduced to the audit team, as well as to understand the ground rules at the beginning of the audit, is actually probably a very good positive first step in showing your cooperation with the audit process. And with that, Colin, Neil, I'll hand it back to you for the next country, if you'd like.
Thanks very much, Jay. As we can see, Japan again has a very different approach. Apologies, everyone, if you're getting an echo. We'll just Japan again has a very different approach to general anti-avoidance, and it depends very much on the tax authorities' view at the time. I'd like to now pass over to Sharath to hear about India.
Yeah, thanks, Neil. Hello, everybody. So I'll briefly talk about the general anti-avoidance rules which have been framed in India, and thereafter I will take you through a couple of tax rulings. So in terms of the general anti-avoidance rules in India, these are fairly nascent. These were introduced only in April 2017. So the first tax year where these rules would apply is the tax year of 2017-18. And mind you, prior to this, in India, we have had judicially developed anti-avoidance rules where courts and appeal authorities have time to time examined whether there was any aspect of tax avoidance in any transaction. But it was for the first time in 2017 that India introduced a formal GAAR code, as we call it. Now, under the GAAR rules, this is primarily designed to empower the Indian revenue authorities to review a tax transaction to see whether these were structured primarily for the purpose of getting a tax benefit. So the main purpose of a transaction or a structure should be with the intent of availing a tax benefit. It's only then can the GAAR rule be invoked. Now, if one were to compare this with the principal purpose test, as we see under BEPS Action Plan 6, there is a slight difference in the sense that the principal purpose test says that one of the main purpose of a structure or a transaction has to be to obtain a tax benefit. Whereas under the Indian GAAR rules, the main purpose has to be to obtain a tax benefit. So in that sense, the Indian GAAR rules are comparatively narrower in comparison with the principal purpose test under the OECD rules. Now let's just take a brief look at the key points of the Indian GAAR rules. Now, before the GAAR can be invoked by the tax authority, there are a fair amount of checks and balances. This has to be first invoked by the tax officer. He issues a show cause notice to the taxpayer. The taxpayer can respond. If the officer believes that this is a fit case for invoking GAAR, he has to then take an internal approval from his superior authority, which is the Commissioner of Income Tax. Commissioner of Income Tax then is again expected to apply his mind. He again gives an opportunity to the taxpayer to present his case. And thereafter, if the commissioner still believes that this is a fit case for invoking GAAR, he has to then refer it to an approving panel. Now, the panel comprises of 3 persons. The chairperson of the panel has to be a judge of the High Court or a retired judge. The second member is a high-ranking Indian revenue officer of the rank of a principal chief commissioner. And the third person is a subject matter expert. So we have a fairly independent panel who finally puts their stamp on having to invoke GAAR, and it's only then the GAAR machinery is put into action. Now, as per the GAAR rules in India, it would override the Indian tax treaties, and there are certain exemptions being given from the implementation of GAAR, especially for foreign institutional investors or foreign portfolio investors. The GAAR rules would not apply unless they want to take the tax treaty benefits. We also have certain grandfathered exemptions. For example, the GAAR rules would not apply to the income earned from the sale of any investments in India. The capital gain that arises, the GAAR rules would not apply, provided these investments were made prior to April 2017. The GAAR rules also clarify that the GAAR would still apply in other cases wherever the structure was pre-existing prior to April 2017, unless, of course, it is in relation to capital gain earned from an existing investment prior to April 2017. So the GAAR rules also wouldn't apply if the taxpayer has made an advance application to the Advanced Ruling Authority, and the Advanced Ruling Authority has confirmed that this is not a transaction to which the GAAR rules would apply. So on the left side, you would see the consequences of a case wherever the GAAR is invoked. Some of the consequences are it can disregard related parties or associated enterprises to a transaction. It can disregard any step as part of the overall transaction. It can reallocate income or expense amongst the parties to an arrangement. It can also disregard the tax residential status, the situs of the asset. It can disregard or look through corporate structures, and it can also treat as if the arrangement was never entered into. Now, we have not seen any practical implementation of these GAAR rules by the Indian revenue authorities for the reason that these are fairly new, and there is a lag between when the audits are done in India compared to the close of the year. So as I speak, the audits for the tax year 17-18 are ongoing, and therefore it will take a while for us to see whether these GAAR rules are actually invoked. If you move to the next slide. So here we'll take a look at one of the advance ruling cases where the advance ruling authority had to look at a question whether the transaction was designed for tax avoidance. Now, in India, any foreign person or non-resident can seek an advance ruling on a question which affects his tax liability in India. And under the advance ruling process, as a first stage, the advance ruling authority has to decide whether this transaction on which a question is sought was prima facie designed for tax avoidance. So in this case, if we look at the facts, this was a case where there was a US company on the top, that's the green box that you see, and there was a Mauritius company, and the Mauritius company was holding certain investments in a Singapore company, and in turn, the Singapore company was holding investments in an Indian subsidiary. Now, the transaction on which the question was sought by the Mauritius company. So the Mauritius company was the applicant before the Indian Advance Ruling Authority. The Mauritius company sought a question whether the transfer of shares held by it in the Singapore company to another Luxembourg buyer, was it eligible for tax exemption in India on the capital gains that it would derive from the sale of shares in the Singapore company. So this is a typical case of what we call as an indirect transfer of shares, because the Singapore company was deriving its value almost wholly from the shares it held in the Indian company. So the question was whether the capital gains, if at all, were taxable in India from the sale to the Luxembourg buyer. Now, in deciding this question, the Indian revenue authorities strongly objected to this, to say that this ruling request ought not to be admitted for the reason that this transaction, they believed, was prima facie designed for tax avoidance. Now, let's see some of the key aspects that the ruling authority ruled in terms of the question whether this was designed for tax avoidance. Now, some of the facts that they concluded were to say that, and they made certain observations. They said that while there was a board of directors of the Mauritius company, in relation to some of the key decision making, they noticed that there were two persons who were not on the board of the Mauritius company, but they were involved in making the key decisions. One of them being having check signing powers for transactions above US $250,000. They noticed that the check signing powers was with these two gentlemen who were not on the board of the Mauritius company, and one of the directors of the Mauritius company had to only countersign the check. And they also said that some of the key decisions were taken wherein the two persons were involved in, and therefore this led to the conclusion by the Advance Ruling Authority that in their view, what they called as the head and brain of the Mauritius company was not in fact situated in Mauritius, but it was situated elsewhere. So they came to a conclusion that the funds of the Mauritius company were not under the control of the Mauritius company, but rather were outside of the Mauritius company. And therefore, in their mind, they thought that the Mauritius company was more of a see-through company or a transparent company. So for this reason, they thought that the ruling request has to be denied, because in their mind, the Mauritius company was set up for gaining tax advantages and not with any commercial objective. Surprisingly, they also came to a conclusion, and this was something that caught all of our attention, to say that under the India-Mauritius Treaty, now under the India-Mauritius Treaty, there is a capital gains exemption that is provided. for sale of shares in an Indian company. So the Advanced Ruling Authority came to a conclusion that the India-Mauritius Treaty never envisaged providing capital gains exemption for indirect transfers, but was meant for providing capital gain exemption only for direct transfers of shares in an Indian company. Now, this conclusion is a little surprising for the reason that something that gets exempted under the treaty for a direct transfer should also give the same treatment for an indirect transfer, because at the end of the day, the ruling request sought was whether there was any capital gains tax liability in India on this indirect transfer. So the consequences of getting a direct transfer exemption under the treaty should have applied to an indirect transfer as well. Now, moving on to the next ruling, the next slide, please. Yeah, this is a very recent ruling. So this was a case where there was a direct transfer of shares in an Indian company. If you see the green box below, GGCL, there were shares held by the Singapore company BG Asia in this Indian company. So BG Asia, the Singapore company, sought to transfer shares held by it in the Indian company to another buyer in India. So this was a case of a direct transfer of shares of an Indian company by a Singapore company to another Indian buyer. And the question that was sought here is, again, whether this transaction is eligible for tax exemption under the India-Singapore Treaty, which provided for a capital gains exemption. And even here, the revenue alleged that this ruling request ought not to be admitted because they thought this was a case of tax avoidance. Nonetheless, in this case, the Advanced Ruling Authority, having gone through the facts presented to it, it came to a conclusion that it cannot be said that this transaction was designed for tax avoidance. And some of the facts that they noticed were that the Singapore company was set up long back in '97, whereas the capital gains exemption was provided under the treaty only from 2005. So it cannot be said, or it could not be anybody's case, that the Singapore company was set up primarily for gaining advantage under the India-Singapore Treaty. They also came to a conclusion, having looked at the facts, that the control and management of Singapore company was located, in fact, in Singapore. They also noticed that this was not a standalone transaction, but was part of an overall restructuring where the Singapore company wanted to divest some of its holdings, including that of Brazil and Italy. So therefore, they came to a conclusion that this was not designed for tax avoidance. They also said that the Singapore company satisfies the limitation of benefits clause under the India-Singapore Treaty, which clause says that if a Singapore company incurs a minimum of Singapore dollar 200K of expenses in every year for the 2 years prior to the transaction, then it will satisfy the LOP clause, and it is deemed to be not a shell or a conduit company. They also noticed that the IRAS, the Internal Revenue of Singapore, also endorsed the fulfillment of the LOB clause under the treaty. There was obviously a tax residency certificate which the Singapore company had. And for all of these reasons, the ruling authority held that the Singapore company was eligible for the capital gains tax benefit under the India-Singapore Treaty. So that's about it. That was a quick glance of the Indian GAAR rules and a couple of rulings which have dealt with these aspects. I hand it back to Neil.
Thank you, Sharaf. What we're seeing emerge is really two different approaches to targeting avoidance. On the one hand, a discretionary approach in the hands of either the judiciary or the relevant tax authority, and on the other hand, a codified approach with specific statutory rules. I'll now pass over to Shanice, who will cover China.
Thank you. For China, there is no particular changes on the regulations in these 2 years, but actually the GAAR was introduced back in 2008. That means if the company engages in a business arrangement without a reasonable commercial purpose that we always talk about and result in reducing its taxable income, the tax bureau has the right to make tax adjustments. This is generally referred to the arrangements whose principal purpose is to reduce, avoid, or defer the tax payments in China. In the past, there were a number of rules issued in China. We have Circular 2, Order 32, Bulletin 6, etc., which all provides the general principles and the legal framework for the administration of the GAAR. According to these rules, the tax bureau in China can apply the GAAR investigation on the different cases, such as the tax avoidance structure, abuse of tax treaty, and other arrangements without a reasonable commercial purpose, etc. And in China, the tax bureau would usually adopt the substance over form principle to assess whether the company is carrying out the arrangement mainly or solely for the tax avoidance purpose. In general, such arrangements usually has the features that obtaining a tax benefit is the sole purpose or the main purpose, and the tax benefit is obtained by using a scheme which is not consistent with its economic substance, even though its form may be permissible by the tax law. In this case, the tax bureau shall make specific tax adjustments by different methods, such as recategorizing the arrangement, disregarding the existence of a party in the transaction, or even reallocating the income between the relevant parties. And in these recent years, apart from the transfer pricing, the tax bureau is concerned about the indirect transfer of the Chinese taxable asset in China under the GAAR framework. The tax bureau here firstly introduced the Circular 698, which is commonly known in 2009, and then it reinforced the related governance by launching the Bulletin 7 in 2015. In the next slide, we will talk about the Bulletin 7. According to this regulation, when a non-resident enterprise indirectly transfers the assets, including the equity of a Chinese tax resident enterprise, through arrangements without a reasonable commercial purpose to avoid paying the enterprise income tax in China, that transaction shall be recategorized. It is no longer the indirect transaction, but a direct transfer of the asset in China, and it will be subject to tax in China. The withholding tax rate for a foreign company is generally 10%. So you can imagine that this may happen when a foreign investor disposes its investment in China, or when the foreign investor carry out the reorganization internally or even with a third party. So the question here is whether the transaction will be subject to tax would depend on whether it has a reasonable commercial purpose. If the transaction is can be regarded as under the safe harbor conditions, such as it is applicable for tax treaty exemption if it is deemed as a direct transaction, or a qualified group reorganization, then it will automatically be regarded as having a commercial purpose. But while if the transaction is under the blacklist, say its main value is from China and without the economic substance, etc., it will automatically be regarded as without a commercial purpose and subject to tax. So other than that, we will generally look into the facts and circumstances of the case as a whole to determine whether the transaction has a reasonable commercial purpose. Today, we would like to share two cases with you, which both involve the indirect transfer of equity in China. The tax bureau conducted the tax investigation, and ultimately, the foreign investors have to pay tax in China due to the Bulletin 7 under the GAAR rules. In the first case, the tax bureau noticed in news about the change of name of an international chain shopping mall. And so it decided to conduct a tax investigation as to whether the investors of the business was changed and whether appropriate tax was paid in China. The foreign investor in this case has entered into a joint venture with a Chinese group by setting up a Cayman company, and then transferred its investment in China by its wholly owned C company as stated in the chart here, through disposing the shares of a BVI company, which is a company in the chart, which directly invested in a Chinese company. The BVI company is 50% held by a C company and halfly held by another third-party foreign investor D company. But the D company in this case has reported the transaction and paid tax in China, while the C company in this case did not report the case because it argued that the contribution of shares in the BVI company is for the joint venture purpose. So it has a reasonable commercial purpose in that case, but while at the same time it also didn't receive any cash or recognize any gain in this transaction. But on the other hand, the Chinese Tax Bureau has determined that this transaction was with the main purpose of avoiding tax, as the BVI company does not have the economic substance and its core value, asset, or income, etc., will all come from China. It is obviously a shell company in the BVI, so even though there was no cash consideration involved, but it is regarded as a related party transaction, where both the transferor and transferee are related parties, and the transaction should have been carried out at the arm's length price with reference to the transfer price of the D company in this case. So at the end, this transaction was subject to tax in China in 2020. The takeaway here is, in this case, the Tax Bureau determined the transaction as the blacklisted transactions. So when determining whether a transaction has a commercial purpose, we shall refer to the factors as stated in the underlying regulations. In addition, the tax filing approach of the counterparty, that means the D company in this case, in a transaction is quite important, because it would be somehow really difficult to defend the position if the counterparties of the same transaction have a totally different view or a different tax filing strategy. And we will talk about another case. Another case is regarding the safe harbor treatment of the Bulletin 7, even though it is an indirect transfer of the Chinese equity. But if it is deemed as a direct transfer, where the applicable tax treaty would allow such a capital gain to be exempted in the source country. So in this case, a foreign investor wanted to apply the safe harbor treatment under the Bulletin 7 by using the Luxembourg and China Treaty, but ultimately it was rejected by the Tax Bureau. The background is the U.S. partnership transferred around 5% of the shares in a Cayman company, which indirectly invested in some Chinese companies to a third party. As this U.S. partnership was not a tax resident in the U.S., so instead of the Lusco pay tax for this transaction, instead of having the U.S. partner to pay tax, it is the Luxembourg company paid tax for this transaction in the Luxembourg. The investor claimed that so it is eligible for the safe harbor under the Bulletin 7 with reference to the Luxembourg and China Treaty. However, the Tax Bureau rejected because there is not a special clause related to the flow-through entity under the China-Luxembourg DTA, where we know that some DTA, such as the China-France Treaty, has such a clause which covers the partnership structure. And so the income is not treated as the income of the Lux partner, and the China and Luxembourg Treaty shall not apply even if it is deemed as a direct transfer. On the other hand, the U.S. partnership itself is a flow-through entity in the U.S. It is not a tax resident there, and so the China-U.S. treaty shall not apply as well, even if it is regarded as a direct transaction. So ultimately, the transaction was subject to tax in 2020. The key takeaways from this case is whenever the investment in China is made through the flow-through structure, then we shall be more careful in thinking about the tax cost on exit, as sometimes the safe harbor treatment or the treaty protection may not apply. It would highly depend on the tax residency status of the partnership as well as the partners and the related contents of the applicable tax treaties. So in summary, we do see that the indirect equity transfer is a hot topic in China. And I think we shall be prepared for the Tax Bureau's challenges if we have such kind of arrangement in China here. So that's the update for China. I pass the time back to Neil and Colin.
Thank you, Shanice. And I saw we had a question in the Q&A. Maybe if you could take a quick look at that, and we can come back to it if it's something that you can tackle before we move to the panel session. But I think it's been interesting, again, that we're seeing GAAR rules in place in China, but the Tax Bureau issues circulars around its views on the application of these rules to arrangements. And in this regard, purpose is a key requirement in the review of GAAR in China. So I think, whilst this demonstrates that each country in the region has its own approach to general anti-avoidance, be it judicial authority or statutory rules, and also different levels of transparency, there are some common themes that we would like to explore with our speakers in the panel session. So Shanice, we can come back to that question. I'd just like to pass to Colin to see if we want to kick things off.
Thanks, Neil. So Neil, as you mentioned, each of the GAAR rules that we've talked about, to some extent, require an examination of purpose, whether it's a principal purpose test, a reasonable commercial purpose, or here in Australia, a dominant purpose test. And obviously, with that comes the importance of articulating and evidencing the commercial purpose of the transaction. So we'd like to hear from each of the speakers on that evidence requirement, as well as any opinion as to the best practices around documentation and any specific country requirements. So perhaps, Cam, if we can start with you.
Sure, Colin. I think probably one observation is New Zealand's approach on purpose is probably a bit stricter in terms of the way our courts have approached it. I mentioned when I was talking about FRUCOR, our Inland Revenue has got very extensive information gathering powers, so you can assume that everything could be obtained by them. So, it does require, I think, a degree of rigour in correspondence, particularly informal correspondence, emails between clients and counterparties and so on. The reality is, although it's an objective test in New Zealand of tax avoidance, judges are human when they're hearing these cases, and so are Inland Revenue, and they will actually look very carefully at correspondence which has got a delineation of tax benefits and expressions like tax advantageous, tax efficiency, thin gap headroom, and so on. One other comment, I suppose, from a New Zealand point of view, consistency is really important. So if you've got a purpose, you need to, you need to take care that, there is a consistency of that purpose and a narrative that's consistent in all respects for it to have credibility if there is to be an audit.
Thanks, Cam. June, do you have any comments from the Japan perspective?
Yeah, so sure. I was actually going to sort of use what you just said, Cam, to sort of support what we're seeing in Japan as well. And then, Colin, I'm going to ask you whether or not you need to move around so you can turn your lights back on. But other than that, yeah, again, the tax stories have become more sophisticated as far as what the types of information they are looking at. So like you mentioned, emails and correspondences, internal emails and things like that, making sure that you understand if those are disclosed to the tax authority, the impact that those could potentially have in a tax controversy case. You also mentioned the idea of consistency with the local positions and global positions. And so again, Japan would be looking at the same thing. And that I think is, especially with the increase of information exchanges and formal agreements within treaties and the like, that is becoming more and more relevant as the Japanese tax authorities have been able to access more information about companies and company groups. As far as evidencing the commercial purpose, again, Japan is very form-driven as far as where it begins with the inspection, if you will. So again, making sure that you have proper documentation and memorialization of transactions. The rule is typically Japan tax treatment follows legal, then accounting, and then tax in that order of preference. So just something to keep in mind as you're looking at the different transactions. Colin?
Yeah, that's really interesting, June. And I guess what that really highlights is that, quite often you may have a dispute in one jurisdiction, but the actual documentation around purpose may be sitting with a parent company in an entirely different jurisdiction. So you've got issues around collection of evidence and also, strategically deploying that evidence in particular jurisdictions. So the importance of taking a regional or in some cases a global approach to dealing with controversies around anti-avoidance is really important. Sharath, perhaps if we can hand over to you just in terms of the Indian experience and whether you've got similar rules there or whether there's any specific country requirements.
Yeah, Colin. So in India, we don't have any rules in black and white in terms of the documentation requirements. It depends on a case-to-case basis. Now, typically, when we look at the advanced ruling cases, most of those relate to foreign into India, and majority of investments come through intermediate Mauritius, Singapore, Netherlands. These are the most frequently used jurisdictions to route investment into India. Now, in some of these cases, the documentation and evidence is very important. For example, the context and the background for setting up these intermediate holdcos, where it involves a secondary purchase of shares in an Indian company, i.e. shares are purchased from another foreign seller, whether this intermediate holdco was set up right from day one, or was it like a permitted assignee or a transferee, where the ultimate parent transfers the shares to this SPV. So these aspects become very relevant, and we've seen the Indian revenue looking at this whenever advanced ruling is sought. Second aspect, which is generally looked at, is the board composition of these intermediate holdcos at Mauritius, Singapore. Do they have enough qualified people to handle the management of these companies, or is it like remote controlled? And what is the quality of the board resolutions and documentation of the deliberation? Of late, in other cases, we've also seen some innovative approach by the Indian Revenue. For example, they also look at social media profiles of some of the employees of the foreign overseas companies, especially in permanent establishment kind of determinations. We've seen cases where they look at the LinkedIn profiles, the Facebook chats, etc. Now, while one can question the evidentiary value of this, but these are some of the innovative things that we have seen. Colin?
Thank you, Sharath. And finally, Shanice, if you could talk to us about any specific requirements in China.
Thank you. Actually, documentation in China is very important if the tax bureau challenges the purpose of your transaction. For China, there are rules which require the company to provide the related documentation upon it is requested by the tax bureau, so that the taxpayer has to prove that it is not for tax avoidance purpose, and it has the commercial business commercial reason. So the documentation would generally include the background information of the transaction, such as the group structure, the explanation letter about its commercial purpose, the documentation about the decision making, such as the board minutes, the transaction documents, the S&P financial statements of the entities, etc. Just in case if the structure has involved the tax haven countries or the SPV, it is also required to explain the business operation of that tax haven company as well, including whether it has the staff, whether it has a physical office there, etc. If on the other hand it involves the related party transaction, then sometimes the tax bureau may request you to provide a qualified valuation report, etc., to substantiate the transfer pricing of the transaction. So at the end, the best practice in China is to prepare and have a stock take of the underlying documentation of the transaction prior to the tax bureau coming to you, so that we will be able to formulate a strategy to deal with the tax bureau in order to defend the commercial purpose of your case. So that's for China. Thank you.
Thanks, Shanice. We probably just are coming close to time, so there is probably time for one more question for the panel. And what I thought would be interesting would be to explore, some of the key issues that we're seeing around particular themes. So one is intellectual property, and the other one is financing. And what are the tax authorities focused on in this space? So I'll open up to the panel, instead of kind of sequentially going through everyone, just see who would like to kind of take that on. Probably just a couple of the panel members might be relevant. And we probably have a lot of controversy in jurisdictions like India and China. So I might invite Sharath and Shanice to maybe respond on these ones.
Yeah, thanks, Neil. So in India, yes, the financing is a critical aspect that is seen. In fact, the codified GAAR rule does talk about something we call as round-trip financing. And essentially what it means or what they look at is whether the funds are transferred amongst the parties in a group to an arrangement. And, the transfer of funds really doesn't have any commercial purpose other than obtaining tax benefit. So this amounts to round-trip financing. This is something that they will look at. The other aspect that they may see, especially in the context of foreign investments coming into India through overseas intermediate structures, is, in a case where the funds coming through, let's say, Mauritius, Singapore, etc., whether the timing of funds in and out of these intermediate structures, is it like back-to-back, both in terms of investments coming into India or in terms of dividend income going back from India to these companies, and is it like instantly transferred out? What is the sort of independence that is demonstrated at these intermediate levels in terms of control over funds? Is that being remotely controlled, etc.? So these are some of the things that they are bound to look at, and these are very important in terms of backing up whenever we defend a case.
Thanks, Sharath. Yeah. I think we might not be able to hear it.
Are you asking me for this question? All right. Actually, the tax bureau in China do also sometimes has concern about the financing arrangement of the company. For example, you know that nowadays the multinational company may have implemented the complicated financing structure, such as sometimes the outbound payment might be categorized as dividend, while sometimes it might be categorized as a kind of interest. But while different category of the amount might give rise to different tax impact, some payment may not be subject to tax, while if it is a kind of financing arrangement, it will be subject to tax. And apart from these, we do have the thin capitalization rule here in China. So you will have to qualify for related rules in order to get your interest expenses in China to be deductible. While we also have the withholding tax mechanism in China here. So whenever there is the outbound payment of the interest, depending on whether you are able to utilize the treaty benefit, then there will different withholding tax impact as well. So because of the complicated structure or arrangement, sometimes the tax bureau would also have their queries on the related tax impact due to the different categorization of the payment and whether you are claiming that you are able to enjoy the treaty benefit, etc. So no matter it is an equity transaction or financing arrangement, then we will have to be careful in, I think, all the specific countries, including China as well.
Great, thank you, Shanice. And I think we're just about at time. So unfortunately, that's all we have time for. I'd like to take this opportunity to thank our speakers, Campbell, June, Sharath, and Shanice. Thank you for your insights today, and thanks to all of you who were able to join us. We would like to encourage you to fill out the short survey that'll pop up on your screen momentarily and tell us what you think about today's program. If you did join us late, or if you'd like to re-review the presentation, it'll be archived for future viewing. If you feel others would benefit from this webcast, please share the webcast via the share this icon or have them visit the debrief's website. We will respond to the questions submitted as soon as possible. Also, if you think of any questions or comments later, please feel free to reach out to either myself or Colin or to our speakers directly. We'd be more than happy to talk to you. And also don't forget to tune in to our next scheduled webcast for part 2 of the series on transfer pricing controversy in the region on Thursday, the 25th of March, and part 3 being tax authority administration on Wednesday, the 7th of April. From all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax Controversy webcast today. Thank you and goodbye.